Welcome to the deep dive.
Yeah.
Okay, let's unpack this. We're taking a deep dive into the latest financial snapshot from a major player in the life sciences and diagnostics space.
Danaher Corporation.
Exactly, Danaher. We've got their second quarter 2025 Form 10Q, the earnings call transcript, and their press release right here.
Quite a bit of material.
Yeah, and our mission really is to cut through the jargon, pull out the most important nuggets of knowledge, and basically give you a shortcut to being truly well-informed about how they're doing and what it means for the future.
And what's fascinating here, I think, is that this isn't just about numbers on a page.
Right.
It's about understanding how a global science and technology innovator like Danaher navigates, well, a pretty complex world. We'll look at their strategy, how they're dealing with challenges like, say, global trade tensions, and where they're seeing exciting growth and innovation. It's amazing how deeply intertwined these financial docs are with, actual scientific advancements.
Absolutely. So let's start with the big picture. Danaher's overall Q2 2025 performance. A snapshot.
Okay.
Looking at the top-line numbers, total revenues increased 3.5% year over year, hit $5.9 billion.
Okay, solid growth there.
And their non-GAAP core revenue, which kind of strips out some of the noise, that saw a 1.5% increase.
Right. And on profitability, what did we see there?
Net earnings were $555 million. That comes out to 2.77 cents per diluted common share. But the non-GAAP adjusted number, the one they often emphasize, reached $1.80 per share.
$1.80. Okay, that's quite a bit higher. And cash flow, always key for Danaher.
Yeah, operating cash flow stood at $1.3 billion. Non-GAAP free cash flow, $1.1 billion.
Which really raises that important question, doesn't it? How does Danaher consistently generate such strong cash flow?
It's impressive.
It really is. It's not just a number.
Yeah.
It points to how well they manage working capital, inventory, turning sales into cash quickly, even when things are volatile. It's a real competitive advantage.
And the CEO, Rainer M. Blair, he seemed to point to that. He highlighted strong execution using the Danaher Business System, DBS.
The secret sauce.
Paired with, quote, another quarter of robust growth in our bioprocessing business and disciplined cost management. Said it helped them beat expectations.
That operational discipline really shines through.
It does. And speaking of leadership making an impact, there's actually some big news on that front. A major leadership change just announced. Yeah, the CFO role.
Ah, right. The succession plan.
Matt Gugino. He's currently the group CFO for their Life Sciences Innovation Group and also VP of Corporate FP&A. He's set to become Danaher's new Chief Financial Officer in February.
Okay, stepping into big shoes. Matt McGrew, the outgoing CFO, he's transitioning, right?
Yeah, moving to an executive VP role as he heads towards retirement gradually.
And McGrew's contributions, since 2019, they've been huge.
Definitely.
Guiding them, launching Invista and Veralto as separate public companies, the massive Sativa acquisition.
Huge deal.
Navigating the pandemic, and all while building up their internal finance talent. It really shows that long-term strategic thinking, Effective succession planning.
That's a strong legacy. So looking at Gugino coming in, what's his background? Is he well-positioned for this?
Yeah, he's apparently well-known internally. Been with Danaher for 12 years.
Okay.
Loads of experience in investor relations, FP&A, M&A, talent development. And crucially, he's got a recent operational experience as a group CFO.
So he knows the businesses.
Exactly. He's inheriting a company that's, executing well, but as we said, in a dynamic environment. His focus will likely be on keeping that disciplined capital allocation going, optimizing the portfolio, navigating those external pressures we're about to talk about, sort of sustaining the momentum.
Right. Speaking of that dynamic macro environment, let's talk about the big picture. What did Danaher actually see out there in Q2?
Well, market conditions in Q2 were generally pretty consistent with Q1, they said. So in pharma, they saw robust global production of monoclonal antibodies, which is key for them, and maybe a modest recovery in R&D spending.
Modest, okay.
Yeah, but academic and government demand still soft. There's ongoing uncertainty around research funding there.
Still feeling those budget pressures.
Seems like it. Clinical diagnostics and applied markets, though, they remain stable.
Okay, so a mixed bag externally. Here's where it gets really interesting, though. How is Danaher actually responding to all these pressures?
Right, and this is classic Danaher. They are intensely focused on what they can control. That means applying the Danaher Business System playbook, DBS, their continuous improvement engine, to offset cost pressures, like from tariffs.
Which are a big deal right now.
Huge. They're aiming for meaningful productivity gains, protecting their financial position by managing structural costs, but, and this is key, still investing in long-term innovation.
Balancing act.
Totally. And their portfolio helps. It's pretty resilient, right? Positioned in attractive end markets, driven by healthcare needs that aren't really optional, plus those strong secular growth drivers.
And that recurring revenue figure.
Yes. Over 80% of their revenues are recurring, consumables, services. That's a massive strength, provides real stability.
And that focus on innovation, it leads to tangible results.
Yep.
Let's talk about some of the new product launches. What came out this quarter?
Yeah, some cool stuff. In biotechnology, their Sativa business launched 2 new Protein A resins, MabSelect SUR70 and MabSelect Prisma X.
Okay, what did those do?
They're designed to basically offer more cost-effective purification for drug production, preclinical and clinical stages, without sacrificing quality. The goal is lower manufacturing costs, more flexibility for customers.
Makes sense. What else?
In life sciences, SCIEX introduced the Xeno 8600 mass spectrometer.
Mass spec, okay.
Yeah, expanding their high-res footprint, better performance for proteomics, lipidomics, metabolomics.
Yeah.
Basically helping scientists speed up drug development.
Faster research.
Good. And then in diagnostics, a new partnership with AstraZeneca. They're using the new Danaher centers for enabling precision medicine.
Ah, the Precision Medicine Center.
Right,
Yeah.
to develop diagnostic tools. The first product uses Leica Biosystems tech, focusing on digital pathology, computational pathology, using AI algorithms to help improve diagnosis, make therapy decisions more targeted.
That really does raise the question, doesn't it?
Yeah.
How will advancements like these actually change healthcare down the line? More precision, better targeting?
It feels like a fundamental shift in how we identify and treat diseases.
Definitely. Okay, let's break down the segments now. Get into the nitty-gritty, starting with biotechnology.
Yeah.
Core revenue for biotech increased by 6%. Within that, bioprocessing was up high single digits,
Strong performance there.
while discovery and medical was down low single digits.
Right, and digging into bioprocessing, which is the bigger piece, consumables really led the way. Low double-digit growth.
Right.
Driven mostly by commercial demand from big pharma and the CDMOs, the contract manufacturers.
Makes sense. They need the supplies.
Exactly. Equipment sales, though, they actually declined. Seems customers are still absorbing prior capacity buildouts.
Ah, digesting the previous investments.
Yeah, and that global trade uncertainty probably contributed to delays in big capital spending decisions, even though they said the funnels were improving.
Okay.
But the overall development pipeline looks robust, especially for monoclonal antibodies. That's over 75% of their bioprocessing revenue. And biosimilars are growing too, so they still feel good about that high single-digit long-term growth outlook for bioprocessing.
Yeah, and profitability in biotech looked pretty good too, right? Operating margins up significantly.
Yeah, really strong. 170 basis points for the quarter. That's 1.7% improvement. And 380 basis points, 3.8% for the 6-month period.
What drove that?
Mostly higher core sales, a favorable product mix, and those cost structure improvements we talked about.
Though there was that small facility impairment mentioned for the 6 months.
Yeah, a $15 million charge in the segment for the half year. Relatively small in context, but noted.
Okay. Next up, life sciences. Different story here. Core revenue decreased by 2.5%.
Yeah, down a bit. The drivers here were kind of varied. Instrument businesses overall were down low single digits.
Okay.
Clinical and applied markets held up okay, but that academic and government weakness persisted.
Still soft.
Right. Pharma spending showed that modest recovery, and China demand apparently improved a bit, maybe due to stimulus funding.
But the drag came from
Genomics consumables, they saw a decline, partly lower demand for plasmids and mRNA from 2 specific large customers.
specific customer issues.
Yeah, plus that ongoing funding pressure on early-stage biotech and academic research labs.
Okay, so that explains the revenue dip. But the margins, wow. Operating profit margins in life sciences just plummeted, down 2,660 basis points for the quarter. That's huge.
Yeah, 26.6% drop. And 14.4% for the 6 months. It's dramatic.
So what on earth happened there? What does this all mean for this part of the business?
It's a really critical point. This massive impact was overwhelmingly driven by one thing: a huge $432 million pre-tax non-cash impairment charge.
$432 million.
Okay.
Related to what?
Related to an indefinite-lived trade name in that genomics consumables business we just mentioned.
A brand name, basically.
Essentially, yes. They did some reorganization, integrated some businesses, and basically concluded this trade name wasn't going to last forever as a distinct value driver, especially given the lower demand they're seeing right now in genomics, including from emerging biotech and those two big customers.
So they had to write down its value on the books.
Exactly. An impairment charge like this basically means the asset's book value was deemed higher than its current fair value or future earnings potential. It's a reevaluation based on market shift.
Got it. But they did check goodwill.
Yes, they did a goodwill impairment analysis for the related units and found no impairment there, so it's specific to that trade name.
Okay. But even with that big financial hit, there's still innovation happening, right? You mentioned IDT and Aldevron.
Absolutely. Within this same segment, IDT and Aldevron played a key role in developing the world's first on-demand mRNA-based personalized in vivo CRISPR therapy.
Wow, that sounds groundbreaking.
It is a major milestone for gene therapies. So, yeah, it's a reminder that even when there are financial headwinds, the underlying science can still push forward.
Good point. Okay, finally, diagnostics. This segment saw core revenue increase by 2%.
Yep, positive territory here. Clinical diagnostics overall were up low single digits. Beckman Coulter Diagnostics actually led the way with high single-digit growth outside China.
Driven by new products.
Seems so. They mentioned recent innovations like the DXC 500i and DXI 9000 analyzers helping there.
Okay. And Cepheid, the testing platform.
Cepheid's respiratory revenue was actually a bit better than they expected. And importantly, non-respiratory revenue grew double digits.
Oh, interesting. In what areas?
Across sexual health, neurology, hospital-acquired infections. It reflects that people are using the systems more broadly, adopting more tests from the menu.
Expanding beyond just COVID testing.
Exactly. Yeah. And their global installed base is now huge, over 60,000 instruments out there.
Impressive footprint. But we need to talk about China and diagnostics too, right?
We do. Core sales decreased in China for diagnostics. This was expected, though. It's the impact of volume-based procurement VBP and some healthcare reimbursement changes that kicked in late last year.
Right, the government pricing pressure.
Danaher anticipates this will mean about a $150 million hit for the full year 2025, which is in line with what they'd previously guided. So no surprises there, but still a headwind.
Okay, so that covers the segments. Let's maybe dig into some of the other financial details, the operational context that shapes these results, cost, margins overall.
Right. So overall, operating profit margins decreased, but that was mainly because of those big impairment charges, especially the trade name one.
Right. Takes out the noise.
If you look at cost of sales, it increased due to higher sales volumes, sure, but also currency exchange rates, product mix, and that small biotech facility impairment we mentioned. Gross profit margins were affected by those same things, plus tariffs. SG&A expenses rose, again, partly due to the trade name impairment, but also some costs related to productivity improvements.
Investing to save later.
Kind of. R&D expenses, though, stayed pretty consistent as a percentage of sales, just growing along with the sales increase.
Okay. And taxes. Anything notable there?
Their effective tax rate was lower than the standard U.S. federal rate. That's pretty typical for them due to their global operations and various tax benefits they can claim. They mentioned that recent One Big Beautiful Bill Act, OBBA, it extended some tax provisions, but Danaher doesn't think it'll have a material impact on their financials.
Okay, standard stuff mostly.
Yeah.
What about liquidity, capital allocation, share buybacks, dividends?
They maintain a strong liquidity position, rely on operating cash flow, cash on hand, and they have access to commercial paper and credit facilities if needed.
How much cash are they holding?
About $3.0 billion in cash and equivalents at the end of the quarter. Roughly $2.7 billion of that is held outside the U.S. Okay. And they are returning cash to shareholders. They kept repurchasing stock, bought back about 4.5 million shares for $1.1 billion just in the first half of 2025.
Significant buyback.
Yeah. And they also increased their quarterly dividend again, up to $0.32 per share.
Okay. Now, we touched on it earlier, but let's circle back to the big external factor.
Yeah.
Global trade tensions and tariffs. This feels like a really critical piece of the puzzle for a company like Danaher. Okay, let's unpack this. How big is the impact and how are they managing it?
Yeah, it's definitely a major factor. The U.S. put significant new tariffs in place, which then led to retaliatory actions from other countries.
Tit for tat.
Pretty much.
Yeah.
Danaher is now anticipating several hundred millions of dollars in incremental tariff costs for the full year 2025.
Wow, several hundred million. That's not small change.
Not at all. But here's the Danaher angle. They expect to largely offset this impact
Largely offset.
through a combination of things: changing their manufacturing footprint, adjusting supply chains, using surcharges where possible, and really leaning on those DBS productivity actions. So the DBS playbook again.
Exactly. But, they acknowledge the full impact is still highly uncertain.
Yeah.
If they can't fully offset those costs, or if demand gets hit because of the tariffs or the general environment, that would obviously affect revenue and profit.
Sure.
And it's not just tariffs. Some governments, like China, are also pushing these reshoring policies, trying to bring manufacturing back home.
Right, localization pressure.
Yeah. Which raises a really important question, I think, for all global businesses.
Yeah.
How do you adapt your supply chains, your whole manufacturing strategy, when trade dynamics and national policies are shifting so much? It's a fundamental challenge.
It really is. So putting all this together, the internal execution, the external pressures, the segment performance, what does this all mean for the rest of 2025? What's the outlook?
Okay, so they updated their guidance. For the full year 2025, they're keeping core revenue growth guidance the same, at approximately 3%.
Okay, steady on the top line.
But interestingly, they actually raised their adjusted diluted net EPS guidance, the earnings per share forecast.
Oh, by how much? They bumped it up to a range of $7 and $7.80. That's up from the previous range of $7.60 to $7.75.
So a 10-cent raise at the midpoint, and for Q3 specifically.
For the third quarter, they're anticipating low single-digit core revenue growth and an adjusted operating profit margin around 25.5%.
Okay. But wait, they beat Q2 EPS expectations, right? Why not flow that entire beat through to the full year guidance? Seems a bit cautious.
It does seem cautious, yeah. While they had a good first half and they sound comfortable, they'll get those planned $150 million in structural cost savings. They are holding back a bit. They're not flowing through the full Q2 beat or the full benefit they expect from more favorable foreign exchange rates in the second half.
Why hope that?
The main reason they cited seems to be maintaining that $1.7 billion estimate for endemic respiratory revenue from cepheids. That can be variable, right?
True. Harder to predict.
Yeah. And they also just mentioned taking a wait-and-see approach generally, given how dynamic the policy and operating environment is, so it feels like disciplined conservatism.
Okay, that makes sense. And what about expectations for the segments in the second half? How do they see bioprocessing and life sciences performing?
Right. For bioprocessing, they expect it to keep chugging along with high single-digit core growth in both Q3 and Q4.
Consistent.
Yeah, they stressed this reflects normal seasonality. Q3 is usually a bit lower volume. Q4 is strongest rather than some big step up in activity levels.
Got it. And life sciences, that was down in the first half.
Life sciences, they expect to improve. From that low single-digit decline in the first half, they're forecasting positive low single-digit growth in the second half.
What's driving the turnaround?
A few things. Better year-over-year comparisons in genomics, hopefully incrementally firmer China demand as stimulus money flows, and getting more traction from those new product introductions we talked about earlier.
Okay, so some positive momentum expected there.
Seems to be the plan.
So we've really taken a deep dive into Danaher's Q2 2025. And the story that emerges is one of pretty strong execution, when you say strategic innovation.
Absolutely, and a resilient business model that's clearly adapting to these shifting global dynamics.
Yeah, from those new product launches in precision medicine, navigating complex trade policies, economic shifts.
Yeah.
It really seems clear they are just laser focused on controlling what they can't control, using that Danaher business system.
And if you connect this to the bigger picture, Danaher's performance really is a fascinating case study.
How so?
Well, it shows how a diversified science and tech company can leverage that relentless innovation, combined with serious operational discipline, to keep growing. Even when facing big macroeconomic headwinds and those one-time financial hits like the impairment charge,
Right.
their continued investment in those highly recurring revenue streams and just their adaptability in this fluid global environment, it really stands out. It feels like a blueprint for success in a pretty challenging world right now.
That's a great point. So for you listening, as you reflect on Danaher's ability to, largely offset these rising tariff costs and maintain a strong outlook, maybe think about how other global industries could learn from their DBS playbook. How can others manage these supply chain shifts, these geopolitical uncertainties? And looking forward, what further scientific breakthroughs might be accelerated by companies like Danaher? And how will their strategic capital deployment, their M&A, their investments continue to reshape the future of healthcare and life sciences?
Lots to think about.
Definitely. Stay curious, stay informed.